Hey, it's Dennis Lindsay with Corton Global Living here in Carson City. I'm with my good buddy Kyle Rush of Guild Mortgage. Listen, man, I just heard the other day on TV that we're going to have some interest rates rise this year. What do you know about that, man?
Yeah, so this is actually kind of an interesting thing, and it has a twofold answer. So what's happening currently economically is that the Federal Reserve is driving multiple factors within our market specific to interest rates. The first is the short-term interest rate that the Feds are working on, and they've recently announced that they plan on increasing that short-term rate in March. Prior discussion from the Fed was that they were going to wait until next year, 2023, to increase these rates. What's important about this is we need to understand what a short-term rate within the Feds does or what it impacts. And those rates are specific to what the Federal Reserve does short-term loans to banks with. So what it's going to affect is your equity lines of credit, your credit cards, your auto loans, short-term financing versus mortgages, which are long-term financing. Now, in the same announcement, the Feds also played into their tapering of mortgage-backed securities. This is a big one for us. The Feds have been buying mortgage-backed securities to the tune of about $40 billion since April of 2020. They also purchased treasury bonds in the same tune, but about another $80 billion. So we've got roughly $120 billion going out monthly from the Federal Reserve to help stimulate our market through this pandemic and keep these interest rates great. Well, now that we've hit goals with unemployment, we've seen COVID kind of trail off, and we know that inflation's becoming a pretty big beast in front of us. The Feds have to taper off that spending. They've met their goals, so they're going to withdraw their money from the market. They're doing that at about $5 billion per month. What that means is that every month for the next few months, we're going to continue to see interest rates rise. When you look at what lending is in a healthy economy, we typically see interest rates over 4%. So we anticipate rates getting into that range very soon. In fact, rates have already come up into the mid to high 3% range.
Wow. Is that affecting people getting mortgages now? Or are you seeing less people coming in? Or
it's been odd because we still have, I'm sure you would agree, we still have an inventory problem, right? And this inventory problem is not specific to Northern Nevada. It's specific to the West Coast. It's specific to a lot of places in the nation right now. So the impact of the Feds raising rates is higher mortgage payments, right? And if we have higher house prices, we have higher payments altogether. So it does impact qualifications. It does make it a little more volatile as you're shopping because you've got to consistently check in with your lender to find out what's changed recently because of interest rate increases.
wow.
And so it's been very exciting over the last few weeks. We're still seeing interest rates that are historically low. In other words, Dennis, what's the highest interest rate you've ever had on a home?
22%. Yeah,
We're nowhere near that, right? So being around 4% is still amazing. It's just, it does change the dynamics of what we're doing, which means you need to engage with your lender and calculate what your qualification looks like and be in communication because these things are changing pretty rapidly.
So, do you think that if people are wanting to refinance, they should do it sooner or later? Or what do you
Sooner.
think?
Yeah, the refinance boom has sort of already eclipsed. We've gone through and taken a lot of these loans and reduced them to some of the lowest interest rates we'll probably ever see in our lives, but there's still opportunity. The opportunity right now is really around debt consolidation and cash out mortgages. When you look at the rate and term market, we did a lot of that over the last couple of years. And what the rate and term world means is we're simply lowering the rate or lowering the term of the loan to get that financing into a more trim and fit position. When we pull out cash out, we're typically analyzing a client's budget, what their ingoing cash flow looks like and their outgoing cash flow looks like. And if we can consolidate some of that debt into the mortgage and reduce the overall budget of the household, it's a very strong thing to do, especially facing things like inflation and knowing that we can lock in these interest rates and they're still considered extremely low in the scope of history.
So, if our listeners here want to get a hold of you,
My name is Kyle Rush. I'm with Guild Mortgage. My phone number is 775-885-6892.
And we will be back with you next month with Mortgage Monthly with my good buddy Kyle Rush. And if you guys are out there listening to this, pass it on to your Facebook page and let them see what we're going to accomplish here. Thanks very much. We'll talk to you next month.
Thank you.